Decentralized finance, or DeFi, is often promoted as a revolutionary alternative to traditional banking, promising open access, high yields, transparency, and freedom from intermediaries. But beneath this innovation lies a range of hidden risks that every user needs to understand before participating. Because unlike traditional finance, DeFi operates in a largely unregulated, experimental, and highly technical environment where responsibility falls almost entirely on the individual. One of the biggest risks is smart contract vulnerability, since DeFi platforms rely on self-executing code that, if poorly written or insufficiently audited, can contain bugs or exploits that hackers can drain in seconds, and once funds are stolen, there is usually no legal or technical way to recover them. Closely related to this is the risk of protocol failure, where even well-audited platforms can break due to unexpected market conditions, flawed economic models, or interactions with other protocols, leading to massive losses for users who may not even understand how or why it happened. Another major concern is rug pulls and scams, where anonymous developers launch attractive-looking projects, encourage users to deposit funds with promises of high returns, and then suddenly disappear with the liquidity, a problem made worse by the lack of identity verification and accountability in many DeFi ecosystems. Liquidity risk is also critical because many DeFi platforms depend on user-supplied liquidity, and during market stress, liquidity can evaporate quickly, causing users to be unable to exit positions or suffer extreme price slippage. Price oracle manipulation is another hidden danger, where attackers exploit weak oracles, the systems that feed external price data into smart contracts, to manipulate prices and trigger unfair liquidations or drain funds. Impermanent loss poses a less obvious but equally damaging risk to liquidity providers, as volatile price movements between paired assets can result in lower returns compared to simply holding the assets. A concept many newcomers misunderstand or completely overlook. Leverage and liquidation risk further amplify losses, as DeFi lending and borrowing platforms allow users to take on highly leveraged positions, meaning even small market movements can trigger automatic liquidations, often with added penalties, wiping out capital almost instantly. Governance risk is also significant, since many DeFi projects are controlled by governance tokens. And if voting power becomes concentrated among whales or insiders, decisions may prioritize personal profit over protocol stability or user protection. Regulatory uncertainty adds another layer of risk, as governments around the world are still figuring out how to treat DeFi, and sudden regulatory actions such as bans, restrictions, or enforcement can cause platforms to shut down or users to lose access to funds. There is also the risk of user error, which is far more severe in DeFi than in traditional finance, because sending funds to the wrong address, signing a malicious transaction, or losing private keys usually means permanent loss, with no customer support to help. Interoperability risk is growing as well, since many DeFi protocols are interconnected, meaning a failure or exploit in one system can cascade across multiple platforms, amplifying damage throughout the ecosystem. Finally, psychological and behavioral risks are often ignored, as the hype, fear of missing out, and promise of unrealistically high yields can push users into making rushed, poorly researched decisions, exposing them to risks they do not fully understand. While DeFi undoubtedly represents an important technological shift with long-term potential, understanding these hidden risks is essential, because participating without proper knowledge, risk management, and caution can turn financial freedom into financial disaster in a matter of moments.